Thank you for joining us today. The topic of our webinar this month is on stock market concentration. And this was a question we received from multiple clients and is something that's been in the news recently. And so this is a good time just to talk about this in a little bit more detail, answer your questions, and explain why we don't think you should be losing a lot of sleep about some of the things you're reading in the news today. But just to start, let's make sure we're all on the same page about what we're talking about when we reference the concentrated stock market. Here's a look at the Russell 3000 index as of the beginning of this week. The Russell 3000 is an index made up of, maybe no surprise, 3,000 companies, but that does not mean each company received the same weight in the index. The Russell 3000, along with other well-known indices like the S&P 500, are market cap weighted, which just means that larger companies receive a larger allocation in the index. And today, Apple is the largest publicly traded US company, worth about $3.4 trillion, and that makes up about 6% of this index just by itself. If you invest $1,000 into a Russell 3000 index fund, about $60 of that goes into Apple directly. And so when you hear reference to stock market concentration, all this is talking about is the fact that these larger names are making up more and more of the index. Or just to say another way, there's getting to be companies out there that are getting really, really large, Apple at more than $3 trillion, that they're just taking up a bigger portion of this pie. And so here you can see on the right, Apple is the largest holding in this, about 6%. The top three, so that's Apple, Microsoft, and NVIDIA today, make up about 17% of the index, and the top 10 make up about 30% of the index. And this, as we'll see in a second, this is high relative to what we've seen in history. And so that gets a lot of people talking about it, right? So here's just some clips of some news headlines that come up when you search in Google News on this issue. And, fear sells. And so there's a lot of talking about how unprecedented this is, how it's distorting index funds, why you should be worried. And as I said, we've had several questions from clients about this, and you are not alone at all if you've read these headlines and wondered if you should be concerned or if this is something that's adding more risk to your investment portfolio. And so in these next couple slides, I want to show data and charts that are commonly used to try to raise concern, trying to convince you why this is a big deal. And then I'll show why we don't think this data means you necessarily need to go out and start making changes to your investments at all. And so most articles on this topic are going to lead with data or chart that shows something like this. This is showing US stock market concentration since 1950. The y-axis here is the percent of the market, and the different lines show the concentration for the top 10 companies, the top 3, or the top 1. So for example, at the end of 2023, the top 10 holdings made up about 27% of the market. This chart was from a paper in late 2023, and so I put on the far right here where we are today, kind of mid-August. And so as you can see, it is true that especially for the top 10 holdings, their weightings are about as high as they have been over this time from about 1950. However, if we zoom out a little bit and start to use some longer term data, today's numbers aren't nearly as unprecedented as they sometimes are made out to be. This is a chart from a Wall Street Journal article about 6 years ago, which is a lesson in of itself, seeing that many people were trying to ring alarm bells about this 6 years ago. But besides that, this data now is looking back another 30 years, so looking in from the late 1920s. And what we see is that when we zoom out a little bit more, we find almost a 30-year period where the stock market was as concentrated and actually even more concentrated than we're seeing today. And just to put some numbers behind what an investment in this period between, say, 1928 and 1965 when the stock market was much more concentrated than it is today. $100 invested about right here in 1928 turned into $3,000 by 1965. And so despite nearly a 40, almost 40% concentration in the top 10 names at one point, investors still fared pretty well, even though, this is coming out of the Great Depression and certainly some other very tough economic times. And besides just looking at the performance of the stock market in those early years, this chart shows performance in that period from 1950 until now. The y-axis here is the weighting of the top 10 stocks, so between 0 and 30%. The x-axis is just all the years from 1950 until now. And green lines show period when concentration is rising. Red shows periods when it is falling. And then finally, the numbers in the chart you'll see here, 16.4, 10.5, 23.5. These are the annual returns that investors received over that period. And so, a couple things to note here. The market has historically done very well when it is consolidating. And so this ends up being an issue of market timing. Returns, if you think the market's going to be more concentrated, you probably want to be invested. Returns are going to be good. And if you think that today's level of concentration is bad, you have to be ready to sit out some periods of very good returns. So if you sell out now, you might see high returns for many more years in the future before concentration starts to go down. As we've seen, concentration can get higher than it is today. And so just because we're at a high level does not mean today is necessarily the tipping point for all this. And then more importantly, even when concentration is going down, that does not mean investors necessarily suffer terrible returns. And so consider this period from 1962 until 1992, when the market saw its largest deconsolidation period in history. Investors still received over 10% annual returns for a 30-year period while this was occurring. And just to put some real numbers behind that kind of return over a 30-year period, $1,000 invested at the peak of market concentration here in 1962 grew to about $20,000 in 1992. So a 20x return is, not exactly something that you should stay up at night worrying about. And so do not necessarily think that if the market is too concentrated today and that if that concentration starts falling, you're going to be in for a poor period of investment returns, because that has just not been the case. And then the final main point these articles talk about when discussing stock market concentration is the history of returns for the top stocks. And so, this would be Apple today. Historically, it's been companies like, Exxon, IBM, GE. And so this chart here is one way to show the performance of investing in that number one, that largest stock compared to the general market. And as you can see in this chart here, the green line would represent your performance if you just stayed invested in the market as a whole. The blue line shows your performance if you always were invested in that number one largest company. And so as you can see, the largest stock has pretty dramatically underperformed the general stock market over this period. And so you see a chart like this and think, oh my gosh, I better not hold the number one largest stock, right? Well, it turns out this chart is pretty deceptive because there have actually been very few companies in history that have held this number one spot. In fact, from 1950 to 2023, there was a total of 7 different companies that met this definition at one point in time. And just a few of those companies held that position for more than just a few months. And so there's really only 4 companies in this list that make up this chart here that we're looking at. And in reality, what investing in the number one largest stock really means is basically owning AT&T from 1950 to 1965, owning IBM from 1966 to 1991 and GE from 92 to 2005. And what you can see from this chart and what this red box here is trying to show is that really what the argument of the number one stock tends to underperform is based on is IBM being a poor investment in 1966. Almost all of the underperformance in this data is just due to IBM's fall from its peak in the late 60s. And so whenever you hear reference about the underperformance of these big companies, what they don't tell you is that the sample size of this data is so small that really one company is just making up the whole data set. And there's also one other company that's held the title of largest stock for a while, and that's Apple. Apple became the largest US company in 2012 and has kept the title for most of the last decade. And it's worth noting that if you invested in Apple in 2012, you did pretty darn good, much better than the general market, in fact. And so if you were using that prior chart as evidence not to hold any Apple shares in 2012, you missed out on a pretty significant portion of the stock market's return. $10,000 invested in the S&P 500 in 2012 has turned into about $56,000 today. $10,000 invested in Apple in 2012 is worth about $185,000 today. And so certainly one very good example of how not to use a very limited data set to make some investment decisions. And then besides looking at just kind of specific performance, there's a few other issues with the argument of today's stock market concentration being concerning. One is that while we can say that the US stock market is concentrated, many other developed countries have stock markets that are even more concentrated. Today, the top 10 holdings in the US make up about 30% of the market, but countries like Switzerland, France, Australia, and Germany are at concentration levels of 40%, 50%, or even more. And so you can certainly be correct in pointing out that today's concentration levels are higher than they have been, but there is really no answer about what a right amount of concentration is or what too much is. There are examples here of countries more or less concentrated that have seen their stock markets have very good long-term returns. And then probably the biggest point in the entire webinar here is that unless you have all of your money in an S&P 500 fund or a US total stock market fund, today's stock market concentration kind of becomes a non-issue. And so, for example, I just took a sample 80% stock, 20% bond asset allocation here, showed just how that would be broken down between not only US large cap stocks, but also small stocks, international stocks, and bonds. And what you end up seeing is that if you were to invest your portfolio in just this kind of allocation, Apple ends up being something like 1.5% of your portfolio. So much lower than that 6 or 7% we've been looking at. And you have many other holdings here that help essentially rein in, Apple's share of your portfolio. And so, know that like so many of the risks we talk about with investing, diversification is really the best way to reduce risk in your portfolio. And this is just another example of that. If Apple does end up becoming, another IBM, being diversified will protect you from that. And finally, I just want to highlight one solution that's being presented to investors on this issue, and that's something called equal weight funds. And to understand how these are different, you need to first understand how most stock market indexes are set up. Most are what we call market cap weighted, which is just what we have been looking at, with the Russell or the S&P 500. The larger companies have the largest share in the index. And so I show here on the right, the largest company in the S&P 500 right now is Apple, makes up about 7% of that index. And one of the smallest holdings is Etsy, which makes up just over 1/100% of the index. And so if you buy a S&P 500 index fund today, about 7% of your money is effectively invested in Apple, about 0.01% goes to Etsy. And so an equal weight fund works a little differently. Instead of the variable weightings of each holding, every holding is allocated the same percent. And so in the case of an S&P 500 equal weight fund, each of these holdings gets about 0.2%. And so there's an ETF out there with the ticker symbol RSP that I believe is the largest equal weight fund out there today. This fund has nearly $60 billion in assets. And so this has been incredibly popular with investors recently. And shown here are just the top holdings of that fund. And so you'll see very different than what we looked at the very start of this webinar. You won't see Apple, Facebook, NVIDIA, those types of holdings as your top holding. Every company gets an initial holding about 0.2%, and then it can go up and down in between when the fund's rebalanced. And so equal weight funds are typically sold as the solution to stock market concentration, but they hide another pretty big risk, and that's a significant overweight of your investments on much less profitable, smaller companies. And so shown here is the revenue and net income of Apple and Etsy last year. And so Apple is just this monster of a company, right? Last year, they had almost $100 billion in net income. And now Etsy was profitable as well, but not nearly as so. Basically, Apple makes as much net income in one day as Etsy makes in the whole year. And so I think anyone, and any retiree in particular, considering equal weight funds should ask themselves, if a company like Apple, being the largest portion of your portfolio, is so bad and so risky, why is replacing the most profitable company in the US with companies with much less history of profitability, really a much better option? We have seen a time when stock market concentration was due to really unprofitable companies. I'm thinking specifically like the dot-com bubble here. But that is not the case of what's going on today. The largest companies today, Apple, Microsoft, NVIDIA, Facebook, Google, make hundreds of billions of dollars in profits. And so I just think you have to invest somewhere. And I think it's a little crazy just to say, Etsy should be the largest holding in my retirement portfolio. And is Apple at 6 or 7% of your portfolio a risk? Sure, I guess it is. But a 20 times higher allocation to Etsy is also a risk. And I think perhaps a much bigger one that kind of gets understated by some of the marketing of these equal weight funds. And finally, just one last note here. Besides that issue, there is one sort of fundamental aspect of these equal weighted funds that makes them inferior. When you look at the stock market, by and large, the returns an investor receives is due to the really high returns of very few companies. And so there are some really good studies on this, and I'm quoting one here that looked back at historical stock market returns, and they found that just 4% of companies have been responsible for the entire return of the US market. This is your Apples, your Exxons, your Googles. 96% of stocks that have existed have produced a collective return that hardly beat a treasury bill. And so what this means for an investor considering an equal weighted fund is that if you restrict your holdings to those 4% of companies that do exceptionally well and restrict that to 0.2% of your holding every year, in the end, you ultimately cannot get the historic returns that the stock market has seen in the long run because you're constantly trimming the returns of those very few companies that are doing well and allocating them to the 96% that don't do as well. Historical stock market returns have only come from investing in those few, kind of home run companies and letting your investment in those companies grow and compound over time. This is letting Apple grow from 0.2% of your portfolio to the 7% it is today. Equal weighted stocks just cannot do that and cannot create the same long-term returns for investors if the stock market just continues to operate like it has over the last 100+ years. And this is shown by a few charts. This chart is from a paper from Vanguard, looking at the historic returns of equal weighted funds versus market cap weighted, the S&P 500 in particular. And we start to see this even in relatively short terms. This is just looking over the last 10 years, for example, and looking at the underperformance that those equal weight funds have had. You've still had returns in the equal weight fund, but notably lower than the S&P 500 on its own. And we see this even more so in more concentrated indices. So the NASDAQ 100, for example, is made up of less stocks here, only 100 instead of 500, and also just is more concentrated. It tends to be tech heavy, so it overweights some of those companies that we've seen do really well recently. And here you start to see over that same about 10-year window, the dramatic difference in performance from that equal weighted fund shown in the orange line here, compared to just a market cap weighted fund that invests in the NASDAQ 100. So just one more example of how in the long run, these equal weighted funds just cannot produce the returns that a market cap weighted fund does. And so in summary, I know we looked at a lot of data, a lot of historical numbers here, and so just wanted to put a little summary in to kind of close this up and summarize everything. First of all, just know simply that diversification is the best way to reduce concentration risk and many other risks when you are investing. If you're a client of ours, know that we create your portfolios to be very diversified, to help reduce the risk of Apple, underperforming. But in general, concentration is just not a predictor of poor future stock market returns. The articles, the news can talk about how it's unprecedented, but that does not necessarily mean we're all doomed here in the future. And so don't equate the two. And, there's always going to be risks when we invest. There's no, risk-free way to just get 9% per year going forward. And there's always going to be some kind of short-term outperformance somewhere. There are going to be years that equal weighted funds outperform the regular S&P 500, but in the long run, dramatically increasing small cap investments that you do with the equal weighted fund is certainly not less risky. It may outperform for a year or two. It has not outperformed for long-term periods. And just recognize too that if you are making any changes to your investments because of this issue of stock market concentration, effectively what you're doing is trying to time the market. And we know from a lot of research that that is not a good way to invest. And just finally, to summarize everything, today's index funds have a very long history of working very well for investors in similar environments to what we're seeing today. And so do not read these headlines and finish and think that you need to be making big changes to your investment portfolio. And so with that, thanks for hanging on with us through that. I know a little bit more detailed than some other webinars we've done in the past, but we just thought, since it's been in the news and been timely, an important topic to try to take some more time and explain. If you have any questions or concerns, we're here to answer those, or of course, you can always send an email or call the office, and we're happy to talk with you a little bit more, talk with you about how this looks specifically with your investments. So we'll hang out for a sec for any questions, but besides that, thank you and have a great weekend.